Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So last video I have completed up to problem number 5. So in this video, 6th and 7th problem I am going to explain. So before starting that, I expect my viewers to have a printout of the problems which I have given in the link under my description. Without having the problem, you cannot understand what I'm explaining. So always keep ready the problems. And all the problems are based on the formulae which I have already given the videos on explanation of all the ratios, formulas, interpretation, everything. So if you have not watched, go to the playlist of my channel, select the subject accounting for management, select the videos of ratio analysis, be acquainted, be perfect on all the formulas, then only you can understand. So take the screenshot of the solutions which I have written on the board, then I'll explain everything in detail. See the problem number 6. Sixth problem I am reading out. The working capital of ABC Limited has deteriorated in recent years and now stands as under. So here the balance sheet is given of ABC Limited. Assets are land and building 1,40,000, plant and machinery, stock, debtors, bills receivable, cash and bank. First of all, you should identify which are the fixed assets and which are the current assets. The current assets are those assets which can be converted into cash within a period of 1 year. And the fixed assets are the long-term assets. It is purchased in 1 year but can be used for a number of years. So here the fixed assets are land and building, plant and machinery. Whereas stock, debtors, bills receivable, cash and bank, these are the current assets. Now liability side, share capital, profit and loss account, general reserve, debentures, sundry creditors, bills payable. The last two items, sundry creditors and bills payable, these two are current liabilities. The current liabilities are those liabilities which are payable within a period of 1 year. And debentures is a long-term debt. It is a long-term debt. Whereas share capital, profit and loss account, general reserve, if you combine these three, it is called shareholders fund. Now, calculate current ratio, quick ratio, inventory to working capital, debt to equity ratio, proprietary ratio, current assets to fixed assets. Specifically, the ratios are given. We have to apply the formula, substitute the values and calculate the ratios. So simple. The only thing, you must remember the formula. So we'll begin with first. It is asking you to calculate current ratio. We know the formula for current ratio, current assets by current liability, CA by CL. And the current assets in our problem are stock, debtors, bills receivable and bank balance. Take the total 3,50,000 current assets. We got it. Current liability consists of only two items in the problem, that is sundry creditors, bills payable. Creditors, bills payable. Total 1,50,000. That's all. So current ratio is current asset by current liability, 3,50,000 divided by 1,50,000, 2.33:1. This is the current ratio. Second ratio is quick ratio. The quick ratio formula is quick assets by current liabilities. Current liability already we got it here, 1,50,000. Quick assets we don't have. You must remember the formula for quick assets. Quick asset is equal to current assets minus stock minus prepaid expenses. We don't have any prepaid expenses, so we can say current assets minus stock is equal to quick asset. So quick asset, current asset minus stock. So 3,50,000 is the current asset and the stock value is 2 lakh. So 3,50,000 minus 2 lakh, 1,50,000 is the quick asset. Now we substitute quick ratio, quick asset by CL. 150 divided by 150, 1:1. 1:1 is the liquid ratio or quick ratio. Next one is inventory to working capital. These are peculiar ratios. That means there are many ratios which by seeing the ratio we can derive the formula. Here inventory to working capital. So the formula will be inventory divided by working capital. Because in between you are having two. So inventory to working capital means inventory by working capital. And remember, inventory means stock. So stock by working capital. Stock already given in the problem 2 lakh. Working capital. The formula for working capital is current asset minus current liability. So current assets are 3,50,000. Current liability is 1,50,000. So 350 minus 150, 2 lakh rupees are the working capital. Now substitute inventory to working capital, stock 2 lakh, working capital 2 lakh. So 1:1. So inventory to working capital ratio 1:1. The next ratio it is given debt to equity. Debt to equity ratio. It's a very important, very frequently we'll come across this ratio. Long-term debt divided by shareholders fund. That is the formula for debt equity ratio. And long-term debt is only one item, that is debentures. So in the problem it is given debentures are 4,20,000. This is the long-term debt. And shareholders fund consists of share capital, profit and loss account, and reserves and surplus. So in our problem, share capital 2 lakh, profit and loss account 30,000, general reserve 40,000. Add up these three, we'll get shareholders fund 2,70,000. Share capital plus profit and loss account plus general reserve 2,70,000. Now substitute long-term debt divided by shareholders fund 4,20,000 divided by 2,70,000, 1.56:1. That's it. Next is proprietary ratio. The formula for proprietary ratio is net worth by total assets. Net worth means shareholders fund. The meaning of net worth is shareholders fund. Already we have calculated shareholders fund 2,70,000. And total assets are given in the problem itself. Total of the balance sheet 8,40,000. 8,40,000. The ratio comes to 0.32:1. The last and final ratio is current assets to fixed assets. Current assets to fixed assets. So in between 2 is given. The formula will be current assets by fixed assets. CA by FA. Current asset already we have 3,50,000. Fixed asset consists of 2 items, that is land and building, plant and machinery. So land and building, plant and machinery add up together, you will get 4,90,000. So fixed assets are 4,90,000. So current asset is 3,50,000, fixed asset 4,90,000. 350 by 490, you will get 0.71:1. That's it. This is the end of problem number 6. Now I am coming to the problem number 7. From the following particulars, make out the balance sheet with as many details as possible. Last 2 videos I have explained you how to make the balance sheet with the given ratios. Here also ratios are given. The ratios are stock velocity 6. Stock velocity means stock turnover ratio. Then capital turnover ratio 2, fixed assets turnover 4, gross profit turnover ratio 20%. Simply we can say gross profit ratio is 20%. Debtors velocity 2 months, whereas creditors velocity 73 days. This is the information given. Apart from that, the gross profit was 60,000 and the reserves and surplus amounted to 20,000. And closing stock was 5,000 rupees in excess of opening stock. So whatever opening stock is there, to that if you add 5,000 rupees, you will get the closing stock. This is the information given in the problem. First of all, how to begin with? See here, gross profit is given and gross profit ratio is given. By using GP and by using GP ratio, we can calculate sales. Once we get the sales, we deduct gross profit. Sales minus GP will get cost, sales minus GP will get cost of goods sold, COGS. By using COGS, we will apply stock turnover ratio formula to get the stock. That's it. Like this, we have to proceed. So we'll start with gross profit. Last line, it is given gross profit as 60,000. And gross profit ratio is 20%. What does this 20% means? For every 100 rupees of sales, 20 rupees is the gross profit. GP ratio, gross profit ratio is 20% for every 100 rupees of sales. So let the sales be 100. When sales are 100, the gross profit will be 20 because 20% is there. So we got the equation that when sales are 100, gross profit 20. But what is our actual gross profit? 60,000. When the gross profit is 60,000, how much would be the sales? So 60,000 divided by 20 into 100, you'll get 3 lakh. So one item we got sales are 3 lakh. Now sales minus gross profit, you will get cost of goods sold. So here COGS is equal to sales minus GP. COGS, cost of goods sold, is equal to sales minus GP, gross profit. So 3 lakh sales, 60,000 GP. So 2,40,000 is the cost of goods sold. This is the information we got it in two calculations. The third calculation will take stock turnover ratio, stock velocity. The stock velocity is given 6 times. The formula for stock turnover ratio is COGS by average stock. We can't, no, we are having opening stock. Opening stock information is given, so we'll take average stock. The formula is cost of goods sold divided by average stock is equal to 6. Cost of goods sold already we got 2,40,000. Divide by average stock is equal to 6. Now we make cross multiplication. 6 into average stock is 6 average stock. 2,40,000 into 1, 2,40,000. So average stock is 2,40,000 divided by 6, you will get 40,000. We got average stock as 40,000. Now, what is the formula for average stock? Opening stock plus closing stock divided by 2. So average stock is 40,000. So average stock, opening stock plus closing stock divided by 2 is equal to 40,000. Now if I make a cross multiplication, opening stock plus closing stock is equal to 2 into 40,000. You will get 80,000. That means opening stock plus closing stock is equal to 80,000. Now it is given in the problem that closing stock is 5,000 rupees more than opening stock. We don't have the opening stock, so I suppose opening stock as X rupees. Let the opening stock is equal to X. Then closing stock will be X plus 5,000. It is given in the last line of the problem that closing stock was 5,000 rupees in excess of opening stock. More than opening stock. So closing stock will be X plus 5,000. Now I am substituting in this formula. Opening stock plus closing stock is equal to 80,000. So opening stock is X, closing stock is X plus 5,000 is equal to 80,000. So we got X plus 5,000 is equal to 80,000. Now take X plus X, how much? 2X. So 2X plus 5,000 is equal to 80,000. Now take this 5,000 to RHS. So plus 5,000 will become minus 5,000. So 2X is equal to 80,000 minus 5,000. 75,000. So 2X is equal to 75,000. X is equal to 75,000 divided by 2. 37,500. What is X? X is the opening stock. Let opening stock be X. So we got the value of X is equal to 37,500, means opening stock is 37,500. And the closing stock is 5,000 rupees more than opening stock. So 37,500 plus 5,000, 42,500. That's all. So we got the closing stock. The next ratio given in the problem is capital turnover ratio. It is given capital turnover ratio is equal to 2. The formula for capital turnover ratio is sales by shareholders fund. Capital means the shareholders fund. That means it includes capital plus reserves, etc. Right? So here capital turnover ratio is 2. So sales divided by shareholders fund is equal to 2. Sales. How much are the sales? 3 lakh. Already we have calculated in the beginning. Divided by shareholders fund is equal to 2. Now cross multiply. Here you make cross multiplication. 2 shareholders fund is equal to 3 lakh. So shareholders fund is equal to 3 lakh divided by 2, 1,50,000. Shareholders fund is 1,50,000. Now shareholders fund consists of share capital plus reserves and surplus. And reserves and surplus is given in the problem. The reserves and surplus amounted to 20,000. Reserves and surplus are 20,000. So shareholders fund is equal to share capital plus reserves and surplus. So shareholders fund we got 1,50,000 is equal to capital plus reserves and surplus are 20,000. Bring this 20,000 to LHS minus 20,000. So 150 minus 20 is 130. We got capital is equal to 1,30,000. Next, fixed assets turnover ratio is equal to 4. Fixed assets turnover ratio, the formula is sales divided by fixed assets. It's an old ratio. Already I have explained this in the previous theory videos. Sales are 3 lakh divided by fixed asset is equal to 4. Cross multiply 4 into fixed asset. 4 fixed asset 3 lakh, fixed asset 3 lakh divided by 4, 75,000. Got it? Fixed asset is 75,000. In this way, one by one item we are finding out by using the ratios. Now we can make use debtors velocity. It is given in months. When the debtors velocity is given in months, it means debt collection period. This debtors velocity is given 2 months. That means debt collection period is 2 months. Year consists of 12 months. So debtors turnover ratio will be 12 divided by 2 is equal to 6. So simply we can say debtors turnover ratio is 6 times, or debt collection period is 2 months. Both means same. Every 2 months we are collecting the money from customers, and in 1 year 6 times we are collecting the money from customers. That is the meaning. So debtors turnover ratio 12 by 2, 6. The formula for debtors turnover ratio, net credit sales divided by average debtors. But we are not given any opening debtors. So simply we can take sales by debtors is equal to 6. Sales are 3 lakh. 3 lakh divided by debtors is equal to 6. Cross multiply 6 debtors 3 lakh. Debtors 3 lakh divided by 6, 50,000. That's all. By using this ratio we got debtors. Now one more ratio, last ratio is given, creditors velocity. Now creditors velocity is given 73 days. This creditors velocity is nothing but credit payment, payment to suppliers, payment to creditors. So creditors payment period is 73 days. Year consists of 365 days. So we divide 365 divided by 73. You will get 5. That means the creditors turnover ratio is 5. That means every 73 days we are making the payment to creditors. So in 1 year, how many times you are paying? 5 times. In a year, 5 times you are paying. So creditors turnover ratio is 5. The formula for creditors turnover ratio, net credit purchases divided by average creditors. Due to lack of information, we will make purchases by creditors is equal to 5. But we don't have purchases. So we can find the purchases by using the formula of COGS, cost of goods sold. The formula for cost of goods sold, opening stock plus purchases minus closing stock. So COGS is opening stock plus purchase minus closing stock. In this equation, only purchases is not known. Other variables we know it. COGS, how much is the COGS? Here you have calculated 2,40,000. So in place of COGS 2,40,000. Opening stock, here we have calculated opening stock 37,500. So in place of opening stock 37,500. Purchases we have to find out. Minus closing stock. Closing stock is 42,500. Minus 42,500. So 2,40,000 minus 37,500 plus 42,500. I am changing from RHS to LHS. The plus will become minus, minus will become plus. So 2,40,000 minus 37,500 plus 42,500 purchase. So purchases we got 2,45,000. Purchase we got. Now substitute purchases divided by creditors is equal to 5. So 2,45,000 divided by creditors is equal to 5. Now cross multiply 5 creditors is equal to 2,45,000. So creditors are 2,45,000 divided by 5. You will get 49,000. These are the complete calculations we have made for all the values. Now, we have to make the balance sheet. The balance sheet we have to prepare. Now, how to make the balance sheet? Here I am showing you. So, balance sheet consists of assets and liabilities. So we will take all the assets and all the liabilities. See here. So this is the balance sheet. In balance sheet we have assets and liabilities. These are the assets and this is the liabilities. Right? Assets we will take fixed assets. The fixed assets already we have calculated somewhere here 75,000. So in place of fixed asset I am writing 75,000. Now I have to take current assets. Current asset consists of stock. How much is the closing stock? 42,500. So closing stock 42,500. Then debtors. Debtors we have calculated somewhere here 50,000. 50,000 are the debtors. Only two current assets we can be able to calculate from the given ratios. Now come to liability side, capital. How much capital we have calculated? 1,30,000. So here you can see 1,30,000 capital. Then reserves and surplus. Reserves and surplus are 20,000 given in the problem. Right? Long-term debt we don't have. Then we have current liabilities. The current liabilities consist of creditors. We got the creditors 49,000. Last item we have calculated creditors. So creditors we have taken, debtors we have taken, fixed assets we have taken, capital over, then closing stock over, everything we have taken. Now we'll see whether balance sheet is tallying or not. If it is not tallying, then we have to make the assumption that one of the item is missing, that is not given in the problem. We have to make the assumption. So first you take the total on the credit side, 1,30,000 plus 20,000 plus 49,000. It comes to 1,99,000. So we are getting 1,99,000. 1,99,000. Now see the asset side, 75,000 plus 42,500 plus 50,000. It comes to 1,67,500. That means our balance sheet is not tallying. We are getting 1,99,000 on liability side, whereas asset side we are getting only 1,67,500. That means some missing figure is there. The complete information is not given. So what would be the assumption? Here under current assets, stock, debtors, one more current asset may be there. The other current asset may be, we can take cash. This is the balancing figure. Balancing figure. So how? 1,99,000 minus 167,500. So it comes to 31,500. So there is a short of 31,500 on asset side. So here I am taking 31,500 as cash balancing figure. So sometimes the complete information may not be given in the problem. In that case, you have to make some assumption to make the balance sheet tallied. That's all. So this is the end of problem number 7. So far, 7 problems I have completed on ratio analysis. Inshallah, we'll continue the next problem in the next video.